Good morning, everybody. This is Patrick MontesDeOca with Live Trading Talk here for April 12th, 2022. We're going to jump right into the markets here. We got some economic numbers that came out. The CPI was at about 8.5%, the highest level in 40 years. So we had the gold market up about $39, $16, $16.90, $19.65. Silver was up 39.40 cents, 25.38 last. We have copper at 4.66. And pretty much we have a lot of green on the screen. What I want to do is take a look at the latest report that came out regarding inflation. Inflation continued to worsen in March as gas and rent costs rose. Live updates. Here's what we need to know basically. Prices were at 8.5% higher in March than a year earlier. Biden will allow summertime sales of higher ethanol gas as prices remain elevated. Pay raises aren't keeping up with inflation. The Fed prepares to raise rates quickly as high inflation lingers. Wall Street hedges higher after the release of inflation data. Price pressures are easing for some goods, but supply chains face new disruptions. Globally, inflation is surging amid persistent pandemic disruptions and war in Ukraine. Airfares add to price pressure as travel, demand, and fuel costs rise. The essence of what we're talking about here is inflation is running pretty hot. And in some cases, hotter than expected. As you can see on this chart here, we have just a phenomenal rise in a short period of time. Consumer prices rose 8.5% in the year through March, reaching the fastest inflation rate since 1981. Stubbornly rapid price increases have been exacerbated by a surge in gas costs tied to Russia's invasion of Ukraine. Fuel prices jumped sharply higher last month, with the U.S. average for a gallon of regular gas peaking at $4.33 on March 11. Gas is not the entire story. Stripping out volatile fuel and food, so-called core prices climbed at a brisk 6.5% in the year through March, up from 6.4% in the year through February. Even so, the core index offered a rare glimmer of good inflation news. It slowed down a bit on a monthly basis, rising 0.3% from February, compared with 0.5% in the prior month. March's data may represent a high watermark for inflation, some economists said. Overall prices increases could begin abating in the coming months, as part because gasoline prices have come down somewhat. A gallon cost of $4.10 on Tuesday, according to AAA. Researchers have been expecting consumers to stop buying so many goods like cars and appliances, potentially taking pressure off the overburdened supply chains and allowing prices for those products to moderate. Here's where I want to interject and try to bring some sense of reality to what's happening here. And even though we seem to reach a level here in inflation that the sentiment seems to think that this is probably the top of inflation. Even the 10-year note is down to 272, down about 6 basis points. And so this has taken a bit of the edge, you might say, on this inflationary front as we pretty much document inflation to be the highest in 40 years. There are a couple of differences between then and now in terms of the economic landscape, so to speak. In 1980, we didn't have the debt that we have today, and interest rates were at a peak of roughly about 19% on the 30-year bond. We're looking at rates on bonds coming off pretty much negative yields. If you take a look at right now, the 10-year note is at 2.72% yield. Inflation is running 8.5%. So we're close to a negative yield of 6%. Okay, and so the dilemma basically that we're dealing with right now is that, number one, are the Feds going to increase interest rates sharply, bigger than expected, meaning maybe a half a point, even a full point may come in as in shock to the market. The market already has discounted about a point increase in interest rates. And so the 10-year note still has room to grow, or to go, you might say, towards that maybe a 3.5% yield. And so we're looking at mortgages already beginning to increase on the 30-year mortgages. And so the pressure is for interest rates to go up. The problem that we have is that they can't go sharply higher because they're going to disrupt the whole economic landscape with a $30 trillion debt. It doesn't take a math genius to figure out 1% increase in interest rates. What do we do to the debt? Never mind the debt going back or the rates going back up to normal 4 or 5%. So we're on the verge, I believe, of possibly, if the inflation factor doesn't narrow the negative yield with a 10-year note, it's going to dictate a deep recession. It's beginning to forecast a recession over the next 6 months. We already had an inversion on the yield curve between the 2 and the 10-year. We had an inversion on the 10-year over the 30-year. The market is telling us something. And so the only thing that interest rates will do is essentially put a lot of pressure in this over-leveraged system that we have, highly, highly leveraged markets. Our own government, obviously, has leveraged the debt up to $30 trillion. And we're looking at the debt to GDP ratio running at 30% roughly, which is unsustainable to continue in this path. So what we have here, obviously, on top of this situation economically here with inflation, we have the pressure developing between Russia and China. China echoes of Russia's alternate reality intensify around the world. China's officials and state media are increasingly parroting Russian propaganda organs on the war in Ukraine, undercutting U.S. and European diplomatic efforts, even after the killings in Bucha. Are we building potentially another crisis with China? When Twitter put up warnings message atop a Russian government post denying civilian killings in Bucha, Ukraine last week, China's state media rushed to its defense. On Twitter, at MFA_Russia's statement on Bucha got censored, wrote Frontline, a Twitter account associated with China official English language broadcaster CGTN. In a Chinese Communist Party newspaper, an article declared the Russian had offered definite evidence to prove that the lurid photos of bodies in the streets of Bucha, a suburb of Ukraine capital Kyiv, were a hoax. Here is the beginning of the propaganda, the beginning of the verbal war, and the risk, again, is that Russia is going to align with China and create a lot of pressure for the Western economies. And one of the ways that they're doing that is basically by eliminating the supplies from that region to the rest of the world. Let's take a look at the markets, at the real markets, the reality of how we are trading this situation, these fundamentals here. And we can see the screen, a lot of green on the screen, and we've liquidated some positions this morning. We recommended to take some profits on silver as we came into this area that is identified basically as an area of supply, an area of resistance. Let's take a look at the standard deviation levels for the day and see if we can make any sense of trading mean reversion, basically, of the signals for the day. These are for day trading signals. The swing and position trading that we have basically is a buy and hold. We've been recommending our clients to buy and hold any short-term profit that you may make. A short-term, basically, we convert that right away into a long-term strategy and continue to buy the market long-term, expecting that prices basically are going to move much, much higher, given any short corrections in the market. So what I'm doing here is I'm trading gold, silver, and Bitcoin, and I'm using standard deviation, reversion to the mean principle. And the standard deviation levels that we're looking at in red basically identify the area where we could potentially see sellers come into the market. We're using a 2 standard and a 3 standard deviation. The sell 1 level is a pretty much the beginning of the range of resistance, you might say, between the prices of 25.27 and 25.64. On the 11th, we saw a high of 25.60. And today, we pretty much tested that high by making a high of 25.59. And here's where we unloaded some of the positions for day trading. This area, pretty much, you're looking at, in terms of a probability model, about a 95% probability model that prices from these levels can revert back to the mean. And we're looking at 25.64 to be the weekly extreme level, the sell 2 level above the mean. And also we're looking at the daily at 25.64. So getting up to 25.60 was pretty close. And sometimes we leave a little money on the table. We recommend actually for traders to use about a 90% target as opposed to 100% target. And so if you walk away with 80% of a move, 80 cents on the dollar is not a bad return. We are flat in silver now for day trading. We're long our derivatives basically in this market, which is where we are building a position. Let's look at gold here. 1966, up $18 in gold. Once again, you see the price came right into the 1977, making a high of 1977. And this basically completed the pattern, the weekly pattern of 1976 and the daily pattern of 1974. And automatically what you saw here is the energy expected, which was that supply or sellers is expected to come into the market. That's exactly what happened here. And reverted right back into the lower end of now this support range that has been built. By the price closing above the resistance level, this level here becomes the support. Now, for the price to rally basically from this level here. So we have to define basically the algorithm. We have the price above the daily VCPMI, which is a bullish price momentum. Even though we completed the target, we came back down, reverted, not quite coming down, breaking that level of support now, which is 1963, and reverting right back up from there. Now, the way this algorithm works basically is, as you can see, the 1976-74 area is what we call a harmonic relationship. The prices are pretty close to one another. If the price is able to close above 1976, it's going to accelerate the market to move up to the 1990, which is our daily target for today. Using the daily data, our target for today is 1990. Once again, a close above 1976 will accelerate the price all the way up to 1990 on the gold. Let's take a look at Bitcoin here. Bitcoin is in a bit of a corrected pattern, but once again, taking a look at the extreme levels or the standard deviation, we have moved into the extreme below the mean. Daily, weekly, and we're in a weekly zone of accumulation. And so coming down yesterday to a low of 39,190 seemed to be the low for this period that in essence identify the supply, identify the buyers coming in here that are willing to buy that supply that is being offered down here. The difference is that what you see here is the buyers are stronger than the sellers. And so therefore the price, it reflects in the price and it moves up. A little bit of a correction to test the lower levels here of support, but the algorithm is saying this is an area where you want to accumulate inventory. You want to add to your position. The trigger point would be a close above 40,950. That would be activating a buy trigger for the day and a weekly buy trigger, or the market coming down and activating the lower level of 39,115. One of the things that I want to point out to you here with regards to the Russian situation, the war is not over. And as we move into the next couple of weeks, we expect that we're going to see a lot more aggressive maneuvers by Russia in the southern eastern area of the Black Sea, of the Oza area. And it is going to pretty much bottleneck any supplies coming into the region. I believe that this is the plan that Russia has, is essentially to block as much essentials to the Western economies. They are the breadbasket of Europe. They provide Germany with the majority of natural gas. They are a big part of Germany's GDP. And for all intent and purposes, my opinion is that this war is not over yet. It's going to go on for a few months at least, until something more drastic unfolds that essentially will bring in NATO into the picture. There's a lot of fear that Poland is the next target. And if we were to move into that area, it increases more the probability that what we're talking about is basically World War III. I'm not sure that we're prepared to move that far. But I do believe that Putin is playing a very serious chess game, and he is pushing Western leaders and powers to the max and testing basically their conviction and testing their unity and testing the power of NATO into the region. So it's not going away anytime soon, and it will begin to affect commodity prices to a larger degree, particularly if we eliminate about 25-30% of the production of grains coming out of that area, coming out of the region. Wheat in particular is being affected tremendously, and we're looking at the price of wheat reaching a high of $11.17 this morning. The previous high that we saw was $13.63 on March the 8th. And as you can see here, in terms of wheat as an indicator, it's come down to a Fibonacci retracement of 61.8%, which was about 977 on the 29th. And has reverted right from this level as it was indicated basically by this indicator, and we're moving now and reverting back up again into what it is an uptrend channel, a very strong long-term uptrend channel that points to wheat testing the high of 1363. Any correction in commodities is a buying opportunity. Any correction in crude oil is a buying opportunity. Any corrections in precious metals, gold, silver, is a buying opportunity. Any corrections in digital assets, in Bitcoin, is a buying opportunity. One of the last comments that I want to make is, according to King World News, the London Bullion Metals Exchange is experiencing a supply cut of about 28% from Russia. And obviously, I don't believe the markets have yet reacted to what this means. By taking out roughly about 25 to 30% of the production of essentials, commodities, metals, nickel, palladium, is going to cause prices to move much, much higher into the summertime. I don't believe we have seen the peak yet of commodity prices. This correction is simply a buying opportunity, expecting that we're going to see supply shortages increase tremendously over the next couple of months, particularly if we do unfold into aggressive confrontation in the Black Sea. Thank you again, my friends, for the opportunity to share this with you. Continue to follow us here. If you would like to join us here in our live trading room, let us know. Like and subscribe. In the meantime, have a great trading day. We'll talk to you soon.